Hello and welcome to the Harwood Report for April 16th, 2018. As always, the Harwood Report is presented by Trade Academy, and I am your host and the founder of Trade Academy, Keith Harwood. Let's start with disclosures. There we go. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Options at risk. Consult with your financial professional before executing any trades. I'm going to talk to you guys a little bit about how I'm looking at the markets now with what happened last week, what's happening to start this week. The big mover so far in the last few days is VIX. I'll talk a little bit more about what my thoughts are on the VIX as well as a result of this, and then of course getting into gold and oil, which have both been significant movers as well. So there's a lot going on here. Let's get straight to fear and greed. It's back up to 27. This is a much more reasonable level. Let's look at where 27 sits on the chart. Still looks like it's got some upside. So some stuff has been resolved, right? The Syria strikes were apparently a one-time thing, just taking out the chemical weapons manufacturing capability. Russia has stated that they will respond if another strike comes, basically, and it sounds to me like there's not much more expected here, and everybody's okay with the way that this went down. It's not to say that things won't change in the coming days, but right now, sounds like that escalation has slowed. Oil prices are a lot higher. That's helped out a lot of those energy companies, and that seems to be impacting junk bond demand. Junk bonds, a lot of energy names are in the junk bond basket, and so that's dropped the spread between junk bonds and investment grade. One thing I want to note on here is this little comment right here. While this spread is historically high, so where they're calling it extreme greed, it's still historically high. So as interest rates rise, if this spread continues to tighten, that wouldn't be incredibly surprising, especially if oil prices continue to firm. So just something to note here, that this extreme greed may not actually be extreme greed on a long-term basis. It's just extreme greed on the short term. VIX is falling faster. This will not be neutral for much longer. This is going to switch to greed here shortly on their metrics. This fear metric likely starts switching back to neutral soon. Stock price strength, starting to see some new 52-week highs and fewer 52-week lows. I wouldn't be surprised to see this go towards neutral. All this is going to drive this fear and greed metric back up into probably the 70s before we're all said and done, as I'm starting to see more and more of these flipping and getting towards the inflection point. You can even see here, S&P 500, 108 and 25-day moving average, it's getting above it. So a lot of this stuff that's extreme fear seems to be drifting towards fear, fear towards neutral, neutral towards greed, and then this extreme greed. All in all, sets up well for the market. And the big driver right now has been VIX, but let's go first to the chart here of S&Ps. S&Ps, higher high, higher low. Looks like we've got this grinding higher. So we had this wedge formation coming up, and now the market's firming out of it, testing the 100-day moving average. 100-day moving average is up above at 27, just under 270. We're looking like we want to play against that. If I do it in the futures instead of in SPY, just because SPY, it gets a little funky with the dividends, you can see that we are it's a little bit different. It's not hugely different, but we tested today the 50-day moving average at 2687. Next up would be the 100-day moving average at 2705. So that's about $2.50 in SPY. Again, very similar to where we're looking in SPY, where I'm looking in SPY. The $2.50 there puts us a little above 270 instead of just below 270. It's a little nuanced, but I think it can matter as we flirt with those levels. Okay. All in all, maybe we reject the 50-day moving average. Maybe we chop below it for a couple days before pressing to the 100-day moving average, or maybe we just press right through. If more stuff comes out bullish, we've got the beige book this week. We've got more earnings this week. If more bullish elements come to the market, it's going to be unlikely for us to, I think, resistance levels and stop. I mentioned the VIX, and I want to press on in this one. So VIX is just falling out of bed over the last 4 days. It's down to 16.5. You can see that the low in March was all the way down to 1330. So there is potential for downside if SPY presses towards the high levels here. March 8th is right there, around 276. I mean, really, basically, we're looking towards 278 for us to get to that kind of level. But just getting back towards 271 here, March 20th. You can see that the VIX on March 20th, there we go, closed around just under 18, but the low on that day was 16 and a quarter. We're getting close to that low already. Below a lot of moving averages in the VIX. Not that I am a huge fan of using moving averages as an indicator in the VIX. Some program trades do use it. It looks to me like the VIX wants to continue lower, but may have little bounces here and there. No obvious support here except for maybe the low there of 1626 in the VIX. There's generally just a lot of selling pressure in volatility. The market is telling us that it's all going to be okay. And when I look over here as well, look at the big contango coming back into the market. April is 65 cents under May. Yes, April expires this week, so maybe it's a little less interesting than May, June, which is a 30-cent contango. June, July, 35 cents. Contango's coming back stronger than it did on the last few rallies. And maybe part of that is that this rally is taking a little longer to start to form. Kind of spiked up, took a week, and then kept going, and then pulled back here. We chopped a little bit. We helped drive realized volatility down a little bit before resuming an uptrend. All in all, I have a bullish bias in SPY because it seems to me like the pressure is still on in VIX. I was looking for VIX to get back towards 17 or 16, but if SPY gets above the 100-day moving average, that may press it down to 14 or even 13. If I go to the subsectors as well, see a little bit more strength even. The Qs are already above the 100-day moving average and pressing towards the 50-day moving average. So the 50-day moving average in the Qs is above the 100-day moving average. That's the one key there. But there's only one, natural resistance point in terms of moving averages left there. And then we start looking at some key levels above, like, the March 27th high, which was 165.62. The Qs have been good. They haven't been the strongest. The strongest coming out of this has been small caps, above all the moving averages, and actually, March 27th high has already been left in the dust. So IWM is showing relative strength here, in spite of the fact that financials are the biggest component of the small caps. There are other things in there, obviously, so it's not just a financial story. But a lot of times when the market's coming out of a bad break, it's led higher by smaller cap names, and this time it's happening. Through these periods, it was a little bit more led by tech. Now it's being led by small caps. That leads me to my first idea generally, and that's an IWM. You can see we're above all these recent highs. Looks to me like IWM really wants to test the recent highs. Wouldn't be surprised to see a little bit of a slowdown once we reach 159, 160. But I also wouldn't be surprised to see us rocket through because it's SPY's technicals that really seem to slow the market as opposed to IWM's. So if SPY finds resistance up $2.50 from here, and IWM then finds resistance up about maybe $1.75 from here, $2 from here, wouldn't surprise me. And if SPY rockets through the 100-day moving average, then IWM's off to the races. But look at IWM vol. So I mentioned that VIX could press 14 or 13. Usually IWM trades at a premium to S&P vol, and right now it's trading in line with S&P vol. So let's just look, mid-November, kind of in no man's land. That's what level we're trading right now in IWM vol. SPY vol in mid-November is around 8.7%. This is not the same as VIX. This is the implied volatility of a different term of options. So what I'm looking at there is that IWM vol is already back to November levels, and SPY vol is still 60% above it, maybe 70% above it. So IWM has really got cheap vol. And yes, I understand that the realized vol has been a little bit lower than, it's under 25. still trading 23% realized vol. And in the last rallies, the lows of realized vol was around 14.7%. IWM vol looks really cheap to me right now. I'm bullish on IWM, but I'm a little leery that the market may pull back and get a washout with some bad earnings this week or something else. So I can enter a hedged long with vol this cheap simply by executing a strangle and having it be long delta. And I add a few weeks to expiration to make sure that I've got some time. It includes the next non-farm payrolls this way. I get the beige book obviously this week. I get a lot of new fundamental inputs in case something goes wrong. And I can look at something like this. Very simply, 156, 153.5 strangle for 367. So if everything's fine for the next 3 weeks, 4 weeks, I still think that the market will press above that 160 level. That puts this worth $4 plus. And if everything goes wrong, IWM may press back down here towards the 200 moving average again. Makes this work again. Plus, I expect to see vol get a bid if there's any real pullback here below 154, 153.5. So that would actually make the strangle start to work a little bit sooner than needing to get to the lows. I would expect vol to continue to come down a little bit here into a rally, but generally speaking, this is the kind of strangle that giving me almost a month for either a new high or a retest of the lows seems logical given these kind of moves we've been seeing. Where in a week we could see another move from the 149 to 150. We could have $6 moves in a week if volatility returns, and if it doesn't, then the grind high back to the upside makes a lot of sense. So that's how I'm looking at IWM right now, and I'll talk more about how I'm looking at SPY and QQQ, where the volatility is not quite as cheap, in the newsletter that I'll be putting out later for premium subscribers. And I'll talk more about the premium product later for those that are interested. But as a hint, it's free for the first month. So if you're interested in getting a little bit more a few more trade ideas for things that aren't just quite as dirt cheap on vol, something to look at. Let's move over to TLT. TLT has been something that has just had volatility very cheap. So the volatility landscape has had that excessively high vol bid in SPY, while TLT has just been dirt cheap vol because the movement's not actually really happening in the bond space. So you can see that, I noted that SPY vol is trading well above November levels, and IWM is just getting back to November levels. Well, TLT vol is at 9%, which is about the lows for the last year. And this is all happening when there's some uncertainty about how many rate hikes we might have this year. Seems illogical to me that bonds would just sit for the next few months. I've been looking at May straddles as a way to play this, and I'm going to continue to look at May straddles as a way to play this. So the 121 straddle right now is 255. That's too cheap to me on a vol basis. But I'll actually say at this point, it probably justifies going out to June. And the reason I'd go out to June is because there's no theta now. So the market's not really moving that much in TLT, but vol is cheap. So a June 121 straddle for 357 seems really cheap to me. It's not saying necessarily that I'm arguing that this has to go above 125.5 or below 117 in the next, 2 months. But it certainly could, and any sort of movement outside of this current range should increase the volatility of TLT and perhaps increase, and if we increase the volatility, this June straddle really is a Vega play, so that would then increase the value of that straddle. I just think that TLT vol is too cheap right now. Usually when volatility is cheap, I go into a strangle, but to give myself something to trade around, being long a straddle makes a little bit more sense in the short term. Once the market starts to look for a new trend, then I can go with a directional long, either the calls or the puts. But for now, the straddle just is too cheap for me. And once we move and vol gets picked up a little bit, that could help just look to exit that and then focus on a directional play. But right now, there's no directional obvious play here in TLT for me, so just the straddle makes sense. Let me move over to gold. Dollar yen is testing the 10-day moving average. It's really looking chop higher in dollar yen, which would imply chop lower in gold. And yet we're kind of chopping higher in gold. Part of this seems to be that there are people buying gold over fears of war and over allocations to commodities. Commodities as a whole were the sector everybody hated. Oil helped fix that problem over the last few weeks, if not a little longer. So people seem to be allocating some money to commodities to get uncorrelated returns to the markets, because the correlation between gold and the market is not negative, it's zero. Gold and markets don't necessarily move hand in hand. What gold does move really well with is the dollar. So the dollar index as a whole is a little weak today and testing the lower end of the range. But that's hasn't been going anywhere. Dollar yen, where gold has a really strong correlation, seems to be chopping higher. Testing the 10-day moving average today. If that breaks, then maybe gold does have more upside. But right now, I would have to lean towards this being a put buying opportunity in gold. If I look at silver, let's see if there's a better short there. The answer is not really. This could go down towards 15 and a quarter, retest that low that is held 5 times here in the last 2 months. It's got 3% downside on the immediate term. This has got 1.5% down to 126 and potentially 3% down towards 124 and a half-ish, the level that held before. So if this short-term low doesn't hold, the low that kept holding in silver was being made when gold was trading 124. That's got a little more downside there if the gold buyer steps to the sideline or a gold long actually has to liquidate. So I like that setup for gold on a leverage basis for the short. Talk more about that one in the premium because I want to give you guys an oil trade instead. So speaking of oil, let's go over USO. All right, a pullback today, but you've got to note here that we're still above February and the March highs. Just giving back a little bit of Thursday. This is not a big, bad day for oil. This is part of the consolidation process. If we start to see oil drop back below these previous highs, then maybe actually the short's justified. But for now, the long is justified more than the short. You can see in OIH, the most hated sector, which has been oil, oil producers, oil companies, is finally starting to get a rally. And while oil itself is trading, at these new highs, OIH is still 10+% below the January highs. And XLE is still 6 to 7% below the January highs. These are names that are finally getting some love, either because the shorts are getting out or because people are starting to realize that allocating some money to oil companies with Brent oil above $70 and WTI above 65 makes some sense. So as always, I look at these two and I decide which one's got the better vol level. Well, let's see. First I go to XLE. And given everything here, 19.5. It's not terrible. It's a little bit above the November high, but again, realized vol is 26%. So on the short term, gamma looks cheap in XLE. OIH, short-term realized vol, it's been around 38%, so gamma looks cheap. And we're trading below these highs here. We're down kind of in the range. This reminds me a little bit of IWM. The lows in this are probably going to stop around 25%, and we're already at 30. So yeah, there's 5% of risk in vol. But with realized vol up here, there's some logic to being long some options in OIH. So I don't necessarily want to go out too far to make it too vague, and since I want some gamma, because like I said, realized vol at 38%, it's pretty nice. 10 days, 37, 20 days, 38. So there's a lot of movement happening here. And if oil's trend continues higher, this could start to squeeze again. So I look 2 weeks, 3 weeks. Let's go 3 weeks to give myself a little bit of time. And I'm just looking simply at some May 4th, 27 calls for 45 cents. So when I look back at the chart of OIH, 27 calls for 45 cents. Just a simple retest of the highs presses us towards 29. Makes it more $2. A pullback or consolidation for a week doesn't kill me. But if we continue higher and this actually turns into a squeeze, then it gets really explosive. So I really like OIH calls. Even though the vol looks expensive, slightly expensive on a longer term basis, this realized vol makes it really hard for this implied volatility to drop much more. And the squeeze potential makes these calls explosive. So all in all, I think this has a really, really interesting setup as a result. So again, I'm looking at those May 4th 27 calls for 45 cents as a way to express that view that this could squeeze. And if the market starts to rally fast and vol comes down, I can look at ways to roll out my calls and talk about that more throughout the week for subscribers. So on Wednesday, I come back and do another update just for subscribers. I've got a newsletter coming out later today that'll talk about my ideas for SPY, the Qs, gold, XLE, etc. And if you sign up now, you get that first month for free. After that, it's $49 a month. So if the ideas aren't helping you generate trade ideas, if my conversation doesn't help you come up with your good trade idea, then you don't subscribe. You don't continue your subscription. But if you like what you're finding, like what you're hearing, you can continue at $49 a month after that first whole month for free. Go to tradeacademy.co/Harwood Report to sign up. You can always email me, Keith at tradeacademy.co, or call me 312-600-8004 with comments or questions. Thanks, everybody, and good luck with your trading week.